Good afternoon, everybody. Welcome back to the Schwab YouTube coaching channel for our final show of the day. It's Markets and Sector Analysis. I'm your host, Kevin Horner. Thanks for being here. We're going to take a look at how we are finishing out the week here today, everyone. We'll take a look at a bunch of weekly charts, see if we've learned anything from what was a bit of a tumultuous last couple of weeks. Usually that happens when I'm away from the office. We get a little bit of volatility somehow, some way. Or maybe it's just that every time I step away, things just get crazy. Who knows if there's any correlation or causation there at all. Today, as I was this morning, I am joined by James Boyd, although this time he is running the chat for us. So say hey to JB there. He and I, of course, always happy to hear from you. You can follow us on X, James Boyd CS, Kevin Horner CS. And as usual, if today's conversation as we wrap things up here is beneficial to you in any way, always appreciate that thumbs up for the efforts down below here, everyone. So thanks for being here. Hope you all are prepared for what is sure to be a nice weekend ahead of craziness next weekend with Halloween hitting. So let's get to our disclosures and then we'll get to the charts. First, please remember that our conversation here is only informational and educational. We are not here making recommendations nor an endorsement for a specific approach to trading the market. We also want to remind you that while we cover and review and offer a technical analysis viewpoint here, we do so by discussing concepts and strategies traders may choose to utilize and employ. That stated, though, we discourage you from making your decisions exclusively based off what you see in the form of technical analysis. All right. As far as an agenda for you all today, it's going to be very basic. We're going to get into charts and charts and charts. And because I'm here solo, that does afford me the opportunity to hear from you. So please feel free to use the chat session there to submit questions. I'm not positive I'll get to any all questions, obviously, but I will try to do so for you in some areas of the market that you might have some interest in. We're going to look at, yes, some daily charts, but I think it's significant on a week-to-week basis to make sure we are reviewing things on that longer-term viewpoint to see if we've made any levels of import. And one of the things we can say about today's move in the SPX, of course, we've got a new all-time high, 68.06 on an intraday basis. Now, we are currently trading essentially at that high for the day. You'll hear me say often that new highs are not a bearish viewpoint. We would love to see some continuation here if we're bullish, though. And I say I'm really ultimately talking traders in the marketplace entirely, of course. We have an opportunity. Right now, we're a little lagging in our RSI on the daily chart. We can push this into overbought conditions. Some traders would suggest this is a bit confirmatory in nature if we could get that. Haven't seen that just yet. Let's see how it looks on the weekly viewpoint here. The chart tells us that even the 20-week 20-week moving average there in that light blue, man, that is a ways away. We're looking at about a 400-point drawdown just to find the 20-week moving average. And notice here with that relative strength index, we just continue to see the uptrend playing and validating the price action move that we've witnessed. So if you're looking for maybe the trend on a longer term basis where maybe, and this all comes down to your time frame, everyone, knowing where you want to move on a close below a trend level can be important. Looks like the 20 might not be fast enough on this weekly viewpoint. It's been quite a while, right? We go back to May 12 since we've been above that 20-week moving average. And if I added a little time here, the interesting thing I believe is this one here, this rally from the lows we had in October of 2023 until we basically broke things down aggressively here in March of this year when we started our bit of our pullback in the form of tariffs and that conversation, that narrative kind of weighing on markets due to the fact that we really didn't have enough data and knowledge of tariff levels to really understand how it was going to impact our markets, nor as well as our individual companies. So watching it here, that 20-week was opportunity every time we came to it. And if you're one of these traders who maybe does not need the day-to-day conversation, then perhaps something like the 20-week moving average is worth keeping an eye on. There's been extended periods here. Let's just look at this. Basically, you're looking at a total of 73 bars with very limited deviations, right? 1 week below it, where we opened below it but finished right at it, almost actually on it or above it. In fact, the close this week was 53. Let me expend this here. 53.44 was the close, and 53.21 was the 20 week. So we opened below it, managed to close above it. Many traders will tell you that that's kind of a signal that maybe that initial weakness was about to be blown out. And certainly the next week we continued higher. The next time we did a breakdown, we opened below it here, and then we made a new high. And then the next time was when things broke down. But notice the difference. That's a green candle, opening weekly, closing bullishly. Opening weekly low, weekly as in EAK, weekly, and then finishing strongly. And then you've got the last one here where we opened below the 20-day and 20-week, and instead of bouncing, we sold down. That's a bit of a heads up as well. So some strength along the way, but in terms of trend management, bearing in mind what's been working, perhaps we continue to work with the very standardized view. What once was resistance can become support. What once was support can become resistance. We happen to be above that 20-week right now. A lot of traders are going to lean into that as it looks into the S&P viewpoint. Now, if I made a quick alteration to that, made that instead of a 20-week, let's make it a 10-week, something tells me we're going to see that moving average maybe hug these lows a little more tightly. So some traders might prefer that 10-week moving average, but let's just see how that looks visually on the chart here when I alter and apply that. All right. I thought for sure. Oh, there. My apologies, everybody. Apparently, it didn't take my edit. We're going to try that once more. There we go. There you go. So now, if you go back and look at it from a 10-week basis, notice how 10 weeks is enough to maybe scare you out of the trend, even though we didn't break trend. I think that kind of stands out, at least back here, right? But now we've been above the 10-week moving average here all the way back to this lovely candle on April 28. And again, tests have been very snug to that 10-week. So perhaps a move under the 10-week would be the significant development given the time frame we're looking at here. As we get to the end of next week, that's going to be, assuming we held this, that would be a 5-month long trend from April. Excuse me, my math is off. That'd be 6 months. That'd be basically all of May, June, July, August, September, and October. 6 full months, potentially maintaining the 10-week moving average. And, you know, one of the things that I hear all the time is when we get this question constantly, hey, you're talking moving averages. Which of those moving averages matters? Well, I like to point out frequently it's the one that the security you're trading, the index you're watching, which one is being most respected. That can give you the greatest amount of confidence to trade the way you might like. And as we looked at the SPX, certainly seems like the 10-week moving average for the last 6 months has been providing that support. When we go into the NASDAQ 100, we're going to see something quite similar. Check that out. Brand new all-time highs. That's right, Art. That's right, Jay. Oh, it's too high. Oh, no, we can't go higher. Of course, I'm being facetious. That is not how we look at that. Again, if you want to manage your trades in such a way as a trader to be a seller into strength, we can validate that viewpoint. But that doesn't mean the trend is over by any stretch. The reason a trader might sell into strength really is tied to their own comfort and preference, not tied necessarily to the trend. So if we basically continue to monitor the trend, you've got new highs in the NDX, not a bearish viewpoint. Here's the look at the weekly on that. We still have the 10-week moving average. Again, 10-week, good for shorter term periods, traditionally. The 20 or 40 week, a little bit more consistent, as you can see. But I have to point out, while it was a little more bumpy along the way in the month, basically the beginning of the year in 24, we did have some deviations along there, right? I mean, just look at the consistency of this move in the NDX. Again, one open below it here, the week of September, the 1st of September, and then we closed basically right back at highs, and it was back on trend. So if you are that trader monitoring such a moving average like that 10-day, 10-week, then opportunity presents itself at the 10-week moving average, and traders look to expose some money. The one thing that stands out here, guys, you're getting validated. You're getting validation. Look at this. This RSI is in overbought condition yet again. So that's the highest on the chart that we have seen the RSI since we made this super strong move last summer, which pushed us into nicely overbought conditions. Now, again, overbought conditions relative to the RSI, those are not negatives. Those are confirmatory in nature. They're telling us the strength of this trend, and that's what we're seeing here. So I'm going to put this back to my basic 20-week moving average. There you go. Boy, it did it to me twice. I'll tell you, Thinkorswim is playing games with me today, everybody. All right, there you go. Back to 20 weeks, apply. There we are. All right, so there's your 20-week if you want to be working with it. But just to give you another visual on the move in the NASDAQ 100, let's look at our small caps. Guys, we are having a nice finish today, 1.4%. This oval's a big deal because if we added some time to our chart, this is going to be our highest, assuming the finish today in the next 48 minutes is identical to what we see right now, then we would have our highest Russell 2000 close all time. That is not a negative. We can also point out the fact that we are pushing back towards overbought conditions in the RSI. The last time we did pull back from the overbought was as we were at resistance. So a lot of traders are basically looking at all of this and suggestion being that we are busting out potentially from a very big range. We have been in this range back to pre-21, so late 2020. It is now late 2025. And you know what? Some of you are already talking about some of the things that many traders are discussing. If there are traders out there in this market, and believe me, there are many who've been denying the broad-based rally we've seen since April's lows, my goodness, they are probably at a point where they have met max comfort. And if that's the case, if they are betting against the market and have met max comfort or max discomfort, the only step to take when you've reached max discomfort is to be a covering trader, meaning covering shorts, which tends to lead to more buying, of course, and more buying leads to more buying. And so the potential exists for a bit of a squeeze higher here, based exclusively off of that, especially when you've got traders and investors alike kind of denying what we see from the trend. All right. Now that makes you wonder, doesn't it? JB asks all the time, why would you deny what you see? You should be trading what you see, not going against what you see. So Russell moving to close at a new all-time high. That would be a fantastic development, not just for it and for the small caps, but for the broad market in general. And I understand there's a lot of us out there who are thinking about the opportunity of the market to continue like this. We are working through difficult seasonal windows and heading toward the end of Q4 with the final 10 weeks of 9-10 weeks of the year. It tends to be that exuberant window. Now that obviously doesn't mean it's going to play that way, but the fourth quarter and the November window and December period into Christmas do tend to be a bit more bullish. And of course, I don't believe, we definitely don't believe in jinxes here. What we do think about is how will I act if things change? If something happens, what steps am I going to take? Where are those decisions going to be made? Scott, I came across your question. I think it's a perfectly appropriate one. If tightening in this way does get lifted, the end of so-called tightening, I would expect that to mean a bit more in the way of liquidity coming into the market. But I would be more thinking of it not from a standpoint of liquidity flooding the market, but rather intrigue and interest in the market increasing dramatically. I feel like that's the narrative around it that would matter more, would be a willingness to add money to the market at a time when, for the last 6 months, they've been denying it, right? And if there's money sitting on the sidelines, we haven't necessarily reached what many traders would suggest is the FOMO trade just yet. I think that many last couple of weeks thought we were in the midst of that pullback, that unwind, if you will. Doesn't seem like that stuck based on some of the action we've had this week. So I think bears watching. Absolutely, we should always pay attention to what the Fed and Mr. Powell have to say. It's going to give us some insights, but by no means does that mean we know how the market's going to take it. So we'll take every bit of it with a grain of salt. Okay, quick look in on the semis, and then we're going back to check on some macro stuff here. I'm going to put another line up at the breakout level. Semis looking strong. We moved into overbought condition on the last move to new highs. We then consolidated for about 3 weeks and have now pushed through. On the weekly, can't argue with that. My goodness, that looks strong. I was talking with JB in Trader Talk this morning about how this kind of resembles a bit of a cup and handle move, right? You've got a little depth of the cup in here, and then up to the actual handle, which would kind of be, let's put that with a rectangle. This looks like a bit of that handle, right? And then once we broke the green line, it was off to the races. That speedy 20-week moving average, way too slow for this group. So, again, watch your candles. Your candle tails can be quite instructive. The fact that we've had a candle like this week, we basically traded the range for this week, or for the last 3 weeks, this week exclusively. The volatility here was tremendous, right? Opening down here at 65.51, adding 450 plus points to a new all-time high in the semis. That looks rather bullish as well. My goodness. And I'm sure there are many of you wondering, hey, what about a potential measured move calculation? Sure, we can do it. Let's just take it from the line, the green line down. Whoops, make that a standard trend line. And then we're just going to approximate it because we know that that's all this is. It's just an estimation for where it can go. It's by no means a guarantee to be achieved. But when you take a look at that, I mean, that's up to 8,000 and we're busting 7. So, hey, that doesn't sound terrible, does it? Right? So, yeah, exactly. If you broke that level, Bruce, I think what you're talking about is the broken neck at the green line. Once you bust that to the upside, it's back to trending, right? And my goodness, it's been super move. Now, again, we don't expect 1,000 points vertically from here. You expect some hemming and hawing and some backfilling along the way. But that's one way that a trader would look at this in potential for what we've seen. And I got to point out once more, when you're thinking about the approximation of a measured move level, always assign a time frame consistent with that of what it took to build the prior range. So in this case, we peaked here in July of last year and we busted it in September of this year. So think 12 to 14 months for the time frame for achieving the range we may have broken. All right, let's see how we're looking from our friend Rachel's charts. Rachel Deschelle provided us the view of the S&P and the NYSE. We've got new highs, new lows down below. And then we've got stocks over the 50, stocks over the 200-day moving averages above. So you can see new lows continue to crater. I mean, what are you going to say? The level down here is incredibly low. We had that little spike 2 weeks ago. When the whole market kind of started to react to the president's commentary on China trade, and then immediately right back down. Seems to be limited, if any, fear relative to new lows. New highs are bouncing, so we did make a new short-term relative low, it looks like, in new highs, but we're moving off of that. From a trend standpoint, if we can get more of those NYSE companies moving to new highs, then we can start to see a little continuation. So bear that in mind. Stocks over the 50-day, we've been about 40%. Now, that was interesting because that's the lowest number we have seen since we had the crater in April. Now that could be maybe short-run support. You know, it's something like when you start thinking about the trends associated with stocks in the S&P over the 50-day, it tells us that the intermediate trend is healthy. And when you look at the longer range trend with the 200-day, you can see that it's quite healthy as well, with about 64% of the SPX over its 200-day moving averages. Not a negative there either, but I do have a fly in the ointment for you all. Let's look at Dow theory. How about the Dow Jones Industrials breaking through resistance here back in August and continuing, closing at new highs here today, and all actually will close at new highs, it looks like. And then that's all well and good, and we want to believe. I feel like I'm Mulder and Scully here. We want to believe in what we're seeing out of these charts, and yet I'm not getting confirmation from Dow Transports. And so when I mention the fly in the ointment, I think we have to bear in mind that transports are lagging. And that's odd because transports tend to be a leading indicator for us in terms of how we are moving products. So with this in mind, we got to get out of this little consolidation I've drawn in here. Basically, we've been here for 4 months. We've gone up and made lower highs along the way. We have held support. So yes, we've held support, but we are not, from Dow Theory's details, validating the high in the Dow Jones Industrials with a new high in the transports. And so it does not confirm it, okay? So we have to know that. Now, you'll tell me, I hear it every time, hey, Kev, this is not your grandfather's market. Look at the S&P. Look at the semiconductors. You'd be correct. Both of these two groups are at all-time highs. So it does matter how you choose to view the market. Do you want to fall back into the standard, traditional Charles Henry Dow theory from 1875 and 1885-ish, or do you want to pay more attention to the current components and composition of the U.S. markets, which has a much heavier allocation to spending and consumerism than to production? Very different market in this decade, the last 3 decades, really, since versus the last 125 years. Very, very different. So please keep that in mind. Yeah, Wiley, I can do that. Let's share Rachel's charts. I'll put her market breadth chart there in the chat for you all. I'll share that grid. Remember, anything we share grid-wise, these are not guaranteed for timing, not guaranteed for their accuracy. They're not a recommendation for their use, but use it at your discretion. Here you go. Right in chat. Okay, Now, let's kick off Dow theory. We'll move out of the macro stuff. Let's look at our sector charts. We're going to move our way down the level here. Energy has still been mired in this trend. I say mired because we still have lower highs and we have higher lows. If we looked at this one on the weekly chart, I think it'll be a little bit more evident that we've had a lack of volatility here. My goodness, it's just gone from very wide vol, right? I mean, we moved aggressively down here, and that was from the November 24 peak to our April 25 bottom, where really this was tied obviously to that the Liberation Day, of course, and the major concern being that tariffs could put a dramatic hamper on the willingness to spend and need oil. Well, we've managed to bounce oil from that level, and energy has bounced well, but oil is not doing what energy needs collectively here. And that's where I think the difference it stands out. If you looked at how oil has been acting, oil, due to, as I understand it, and I am not an oil trader, but as I understand it, we've seen this become a story of supply and oversupply, or a willingness to offer more barrels, which is pushing oil, has been pushing oil lower. But something to keep in mind, it is also a positive for the broader market if oil continues the downtrend. If we are in fact rejected here, as my oval highlights for us, I'll zoom in here. If we are rejected, and boy, there is a beautiful shooting star doji happening as we speak, right from resistance through the 50-day moving average, possibly closing at a new low, with RSI making a lower low as well. This could spell an even lower move in oil specifically. Everyone, that is disinflationary, and today's CPI gave us that indication as well. It is the reason, the broad reason at least, for today's narrative-based rally in the broad markets. So disinflationary, good. Oil going lower potentially, further disinflationary, equally good for the markets. So that's what we're getting. That's why you've seen the Russell making the nice move today, perhaps, as well. Even though we saw that yields were up a little bit today, they have cooled further here. So notice we're up only 0.1, and that downtrend seems to be pretty well in place. Probably not terribly concerning as it relates to the 20 moving average here in orange, because we've been above it so much. But if I pulled off the 20 in favor of the 50, I'll tell you what, the 50 sure looks stout here, doesn't it? Let me pull my downtrend, my manually drawn downtrend line in, and just point out how there's your 50-day, there's your 50-day, there was your 50-day right in this range. This was very close to it. So ultimately, the 50-day seems to be perhaps the most important of the moving averages to keep a close eye on yield as well. Okay. Okay. Great question, Tam and Honey. The difference in terms of this is an index, and the XLE you mentioned, that's an exchange traded fund. So we can't discuss those in these segments here. So we lean into the indices where as much as we possibly can. It eliminates our requirements for providing more disclosures in detail. So we're going to stick with our indices so that we can keep making an understanding of the movements in the broader market. You can, in theory, pick and choose which of those ETFs you want to work with. I'll encourage you to do just that, but basically line up and look for and perhaps an exchange traded fund that matches these 11 sectors if you're wanting to do that, okay? Nothing wrong with that. That's perfectly appropriate because the indices themselves you can't trade, so you do need a vehicle by which you could trade them. Here's the look at materials. Let's put back all my major moving averages once more. 20, 50, 200. Materials has been in consolidation, allowing the 200-day to continue to act as support. Remember, we were below it. from December of 24 all the way until the breakout in July. And then a quick throwback test led to continued view that the 200-day as a long-range view for materials is a possible area of support, important support, by the way. Here's how that one looks on your weekly. All right, kind of standard, right? Doesn't scream at you that you need to be a buyer necessarily, but not a bearish look at this point necessarily. Moving on down, industrials. Industrials tried to break today. We got to the upper portion of the range. Didn't happen, but that doesn't mean it won't. We are making still lower highs in RSI. Yes, we would like to see that replaced with higher highs. So we would like to see the RSI trading through that last peak. But that would be the case most likely if we saw the group break out from here. About, let's see, a 1320 down to 1250. So you're looking at about a 70-point range opportunity here in industrials. Taking a quick look at that on the weekly, once more, notice the speed of that 20-week moving average catching up. I'll tell you what, when you start thinking about that, let me clear this set real quick. Doesn't this also have the makeup, have the potential look of a cup and handle to a certain extent, right? Look at that handle basically right here. And then once we broke, we've consolidated yet again, allowed that 20-week to catch up. Now we've held the 20-week every step of the way. Again, nice look on a trend basis for many traders. Let's pop into, JB and I discussed this morning, discretionary. It was a little bit hotter today, but it's not held. So we're now turning a green day into a red day in terms of discretionary. We're not going to lose our minds over that. We're still above the two big moving averages in this case, the 20 and the 50 now. And for a lot of traders, they'll tell you that that's the more important aspect, is that we remain above here. So the fact that we've got those last few days basically holding all three on a closing basis, 4 days in a row holding both the 20 and 50 over the last 4 days, that stands out more than today's action might necessarily. And again, big candle day there yesterday as well. So kind of another indication that it's not exactly you and me out here trading this group, but maybe some institutional investment. In fact, if I was going to do anything else as it relates to volume, I'll just point out, you can always add in average vol, and you might consider doing so. Volume average can be a good indication as to when you're getting institutional investment. I wanted to move that into the volume pane. My apologies. There we go. So what are we looking for? You want to pay attention to the days where the volume spikes get through the average of the 50 days, because we, your retail traders, you and me and my grandmother and yours, we don't have the dollars to push volume like this. In order for volume to be excessive and through the 50-day average vol, it has to come from institutional or so-called smart money. So pretty interesting stuff there, especially since we've basically seen a validation of the trend line at the 50-day moving average. Now, the Staples continues to struggle. That's good if we want to be risk on, right? Risk on traders, what are we looking for? A denial of our defensives. And I think it's kind of interesting to me that we had this new short-term low, basically the lowest we had traded since the April window here in Staples. Staples got a decent rally, but look, we're basically failing, making a high here that's shorter than or lower than the high we made back here. Okay, so that stands out. We're kind of getting rejection level stuff at the 200-day moving average. We're sitting on the down-sloping 50-day moving average. One key there, down-sloping 50-day moving average. Downslope to your moving average implies it's less likely to act as support. So it might be sitting on it, but it becomes very difficult to validate in here. Yeah, it's a bull flag, but Rita, it's a bull. Not all bull flags are created equally. Bull flag that you're looking for is the one like, well, in an ideal, I mean, on this chart, it would look better like from here, this looked great until it broke down, right? This looked more bull flaggish, but it's all about everything that happened before. So the fact is, we are at a spot where a bull flag just looks like running into resistance. It is a bull flag, but not all bull flags are created equally. Even this one, this was a lovely little bull flag, and it didn't maintain, and it was little, tired, but they're not all the same. All right. So what are we looking for? If we're looking for true bull flags, we want to see something like, let me see here. Well, let's just keep on moving down. I know we've got plenty of them. That's for sure. We'll keep moving here. Healthcare, I wanted to touch on. Okay. Now, why does this one look differently? Well, because we have broken a downtrend with the breakout in healthcare. So this bull flag kind of stands out a little more, doesn't it, Rita? See, the difference here being we have busted or broken something that was long-term in nature. I think that stands out more. So if I change this to a 2-year chart, you'll see the peak here, right? So, this looks different than the one there that we just saw in Staples, and quite a bit different as it turns out. So here's your look on the weekly. It's a little messy now because I've got all that stuff drawn in. Let's clean that up. Pretty good. This level, I think, is the one a lot of traders are watching. Just that break out, right? Get you through the downtrend line. It had been kind of lengthy, September into September, so about a 1-year downtrend that has played out. And you could say it was a 1-year, more or less a 1-year channel to the downside that has now reversed. So that's, worthy of keeping a close eye on. Okay, let's see. Financials, 1.25 today, still kind of consolidating in here, but ultimately in process of making a decent move. Notice the RSI got kind of low here on this pullback, and that makes sense because it broke the 20 and the 50-day moving averages and found horizontal support back here at that June gap level, which I think a lot of traders would say kind of coincides and reminds us of the importance of the 200-day moving average. Tech moving strong today, up 1.8% collectively. Great move. Looks a lot like the NASDAQ. No surprise there, right? And then communications that JB wanted to make sure we touched on this morning is still in consolidation, but my goodness, this is, and I've said that a few times today, my goodness, this move here back above the 20 stands out now, doesn't it? Because now that we were below the 20 for about 3 weeks in here, right? September 29 until October 17. Yeah, about 3 weeks. Support in the 20 along the way. What once was support can become resistance, right? Here's like four spots where it was obvious support. And then once we broke it, it became resistance, right? And so where did we pause? When we rallied, we paused for 3 days at the 20 overhead. And then we had to pop through it. So what did we do? We came back and tested it. And everybody listen, it can be that simple. It really can. It's okay to fall back on those very specific details, right? Higher highs, higher lows. Did I get through the moving average? Was the moving average previously resistance? Yes. Now am I through it? Great. Now it can be support. Fall back into those very generic details. It can be comforting and it can help you out with your process a little bit. I think that is a pretty intriguing look from the communication standpoint. I'll bet the 20-week looks great there. Sure enough. Now, here we go, Rita. Let's pull back on your question about a bull flag. This looks like a bull flag on a weekly chart, doesn't it? Strong run off the 100-week moving average at the April bottom. And now, there's your bull flag. That's the flag that bullish traders are looking for. Bull flags at new, maybe 52-week highs, maybe all-time highs. But regardless, that looks like a strong bull flag, as it would have if we went, back in here, right in this window, right? This was a nice little bull flag setup here over about a 5-week pullback to the 40-week moving average, right? And again, sometimes the flagpoles aren't as steep given your time frame. This one's very casual, but by the same token, that's what we're talking about. Okay, we want to see bull flags that start flagging at highs, and then that consolidation can lead to more upside or continuation. Okay. And then the big ones today from a sector standpoint, moves in utilities. So again, yields falling, yields staying depressed gives a lift to the utilities. Today, the conversation once more came back to the quantum stocks, where we have seen quantums being hammered for a very quick period over the last couple of weeks. They've been pulling back. I even used the wrong term. I said unwind. Really, that wasn't an unwind so much as it was a pullback. And utility space, the group providing us with the power for AI has been the major benefactor from it, right? So utilities continuing to look strong. And then real estate also looking stronger than it was maybe this morning when JB and I were on, got up into that band of resistance there. That bears watching here once more. So traders are clearly looking to take on a little bit more risk than we had been, right? They're fine to do that because the risk-free rate of return now is only 3.8%. And as JB called out, if it's 3.8 and inflation is 2.8, then you're really only making an addition, 1% beyond with your risk-free rate of return. And traders, investors as well, they're going to look for greater opportunity. They're going to be more willing to take a little bit of risk. So that's where we are there. And then the last ones we'll look at are some quick hits on the futures today. These are not going to discuss futures trading in any way, just some specific futures levels. So we'll look briefly at gold on the daily chart, which is testing the 20-day for the last 3 days. That stands out. And I think a lot of traders would simply look at that action and say 3 days in a row, tails all on the 20-day, makes the level there that we've now tested quite important. So eyeballs on that 4,070 level approximately as it relates to the price per gold. Eyeballs on silver, on the other hand. Oops, if I can get my fingers to work. Similar spot, right? Except that we're below. Now, this is kind of notable because if you're sticking to the technical analysis to the letter, the fact that we're below the 20-day, yes, we've got those tracks there, a number of key tests at support, but some traders would only have comfort over the 20-day moving average since we've been at it 3 times in a row and not through it yet. So be thoughtful as it relates to that. And then the risk on trade does not seem to be playing well with our technicals on crypto. Ethereum struggling. That's a new short-term low, the lowest we've seen since the rally began in August here. So we've fallen out of range. Now, we could be stating that it's simply at range, but this is an important level for Ethereum, and the same can probably be said on Bitcoin, as you can see. Now, the difference there, right above the 200-day. So it doesn't seem like the participation has been as heavily involved with crypto in this particular move, this particular bounce, but I felt it was notable. So with that, looks like we are at time. I want to thank you, all of you, for being here and having a wonderful Friday. I hope yours was as good as mine was. Big day in the market here. Always great to close the week strongly and do so with a carry as opposed to a breakdown on a Friday afternoon. So this may give traders a little bit of confidence that we're going to look forward to next week for some additional upside opportunity. Now, quick look at that calendar. Don't forget, Market Watch calendar. Put up your earnings flags. Do so for your individual groups Maybe you want to do it for your individual account positions. Maybe you want to do it for the entirety of the S&P 500. You can see where you're going to get your opportunities starting next week. We have earnings on Monday afternoon with a few, and then Tuesday was going to be a pretty busy day. You got 13 of the pre-market stuff, some home builders in there, I think. Yeah, there's at least one home builder in there. So plenty to keep an eye on, as I will be back on Monday with my friend Mike Bruskoff for Trader Talk at Market Open. So I hope you all have a fantastic weekend. Get some rest. Be prepared for the final week of October. I will be ready to rock and roll at Market Open with all of you Monday. I look forward to seeing you then. Thanks again, everybody.